Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures pushing higher this morning. That's after the S&P 500 closed at yet another record high. Traders are optimistic today after the White House announced a trade deal with Japan. The U.S. will now impose 15% tariffs on imports, including automobiles from Japan, as that country creates a $550 billion fund to make investments in the U.S. The deal spares Japan from a threatened 25% tariff that was set to take effect next week. Plus, the meme stock frenzy is heating up on Wall Street. GoPro, Krispy Kreme, Beyond Meat are surging in early trading today. The moves come after retail traders piled into Kohl's and OpenDoor this week. Retail traders now responsible for nearly 21% of total equities volume in the U.S. That's according to Bloomberg. And investors are gearing up for big tech earnings. Tesla and Alphabet kicking off Magnificent Seven results after the closing bell tonight. Tesla expected to provide updates on its outlook for the full year amid an ongoing sales slump. Investors will also be listening for information about the company's autonomous vehicle efforts. And meanwhile, investors will look for clues on Alphabet's ability to defend its search engine empire amid growing competition from AI startups. Let's get a check on stock futures right now. We are seeing indications for a higher open. However, the NASDAQ is lagging those gains a little bit. It's only pointing to a gain of less than 0.1% at the open. In the meantime, the S&P 500 building on yesterday's record close, pointing to a gain of 0.4%. Dow futures indicated higher by about 0.5%. Let's turn now to our top stories of the day. Futures rising after President Trump announces a trade deal with Japan and second quarter earnings rolling in. We've got results from, among others, AT&T, General Dynamics, GE, Vernova. Plus, meme stock fever continues to spread on Wall Street. Joining me now, senior reporters Ali Canal, Josh Schaefer, and Inez Ferre. And guys, first of all, we had this Japanese tariff deal being announced. So 15% is the baseline, which spares an uptick in tariffs that was expected for August 1st, that deadline, right, for the tariffs to change here. And so really implications here for the country's auto industry in particular, and maybe raising hopes about other deals. Josh, you and I have been talking recently about that the market's not moving on trade headlines one way or another. Does today disprove that? What do you think?
I don't know if it fully disproves it, Julie. I think you're seeing futures move higher, sure, but when you look at sort of what's moving specifically, I think you could really sort of pin that down to specifically what this trade deal was. And as we've been making that argument that maybe trade deals aren't moving the broader market, we have been pointing out it has been moving sort of sector-specific items, right? And so really, I don't know if futures necessarily took off this news last night, right? If you looked at a chart of just S&P 500 futures, but where you are seeing the largest moves or where you would expect to see moves when the U.S. and Japan make a trade deal, right? So Nikkei futures are up about 4%. A stock like Toyota is up over 13%, at least it was the last time I looked, in pre-market trading. So you're seeing the areas of the market that would be most impacted by this deal definitely move higher. But I don't know if necessarily the broader market is really rallying off this news. And I mean, we're up about 35 basis points on S&P 500 futures. So yes, we're higher, but I mean, we're kind of creeping higher here in the same fashion we have been really over the last couple of days.
Right, and clearly the implications bigger, to your point, for the Japanese market and some individual Japanese companies than here in the U.S. Inez, there's also this investment that President Trump talked about, right? $550 billion. It sounds like it's going to be sort of over time. President Trump says he's going to have some discretion over where that money is spent as well. So what should we be looking for there?
Yeah, and what we should be looking for is some of the areas that have been doing well to continue to do well when it comes to these investments. You mentioned $550 million. It's expected that some of that will go into semiconductors, into energy infrastructure, pipeline infrastructure, also aerospace and defense. So these are sectors that have been doing well. The industrial sector has been doing well. So this is part of a trade deal that's very bullish for the market. And look, as far as the trade deal is concerned, it's bullish overall because Japan is a key ally of the U.S. in Asia. So this gives optimism, hope for other perhaps countries and blocks of countries, i.e. the EU, to also be able to come to a favorable deal, because the market is basically saying this is better than feared. And that's what you're looking at when you look at Toyota stock. You're also seeing that with some of the German automakers that are also up as well, because of that optimism that if this could be done with a key ally of the U.S., then perhaps other deals could follow as well.
Yeah, I thought Peter Bookvar, who longtime commentator, out in his morning note, said a couple of interesting things. First of all, he points out, even though there is maybe a hope that U.S. automakers would be able to sell more cars into the Japanese market, guess what? U.S. autos aren't tariffed in Japan. There hasn't been a tariff on them, he points out, at least since 1977. So he says maybe there's some other reasons that U.S. cars have not been selling in Japan. He also, repeats the sort of line that we've heard a lot, you guys, that this is ultimately a tariff on U.S. consumers. So even if it's less than the worst case scenario, it is still going to be higher than it was, and at least some of that cost is going to get passed on to us. And then there's the dollar equation, Allie, which has an effect on how much what the tariff effect is going to be.
Yeah, and we've seen the dollar weaken considerably against other currencies. The U.S. dollar index is down about 10% since the start of the year, and that's going to be a bigger tariff burden, or lead to a bigger tariff burden for companies and consumers. Now, we have seen companies so far absorb a lot of that tariff impact, but Goldman Sachs economists are now saying that the U.S. effective tariff rate is going to be around 15%. This is significantly higher than what we saw at the start of the year. And even on the consumer price side, we have seen tariffs start to trickle through a little bit when it comes to certain products like apparel, furniture, footwear. But as this U.S. effective tariff rate rises, as we solidify a lot of these trade deals, and then you factor in the weakening dollar, it's going to be harder and harder for companies to fully absorb these costs without having it hit their bottom line. So that is really where the rubber meets the road here when it comes to how prices could continue to tick higher, and at what point do these companies have to pass on some of those higher costs to the consumer.
Guys, I know you're all hot to talk about the meme stock resurgence here this morning, so let's talk about that. Josh, we talked a little bit about it yesterday, right? And it seems like when we get these spurts of activities in the memes, they do tend to last a little while here. The longer it goes, what are some of the commentary you're seeing that stands out to you?
Yeah, Julie, I mean, one thing I think to sort of put the meme stock rally into perspective is this is kind of just the continuation of what one of the biggest trends in the market has been since the April bottom. It's been a lot of short covering, right? So we were speaking to strategists. I remember writing a story back in May. Going to sort of short covering was what brought the broader market back, right? A lot of people were quote unquote offsides, not necessarily bullish, perhaps positioned short. Then Trump sort of flips the tariff dial the other way. The market shoots higher. A lot of people got caught offsides in names like NVIDIA, right? Well, now you've seen that just move into smaller and smaller companies. So Bespoke had interesting research pointing out that the top 100 most shorted stocks in the Russell 1000 index have outperformed the overall Russell 1000 index by 33 percentage points over the last 3 months. That basically encapsulates the rally from the bottom. So you really, when we talk about meme stocks, we're talking about short covering, right? I think you could really just say this is a trickle-down effect of what has been a very popular trade and a very profitable trade for traders over the last 3 months at this point.
Yeah, and we're going to talk much more about that over the next few hours with various guests. I want to get to earnings as well, because Josh, you're also looking at what the earnings reactions that we have been seeing, how stocks have been doing after companies report. What trends have been emerging?
Yeah, Julie, this has been an interesting one because we spent some time on this show talking about how Netflix sort of surprised to the upside, right? But then the stock didn't really react well, and we were wondering if that was a read-through that maybe things have run too far in this market. But when you zoom out and look at S&P 500 companies over the quarter thus far, Julian Emanuel over at Evercore does great work on this, tracking one-day stock reactions. And stocks that have been beating on earnings and beating on revenue are rising an average of 2.8% this quarter thus far. Again, pretty early in the quarter, but you can see on your screen there, the 5-year average is a 0.8% pop. So beating on both the top and bottom lines is still impressing this market when we think broadly about the S&P 500, of course, with two big names, Alphabet and Tesla coming tonight. It'll be interesting to see how those stocks react in the day following. But again, the stock reaction remains kind of one of the key things here. As we know, most companies are beating. I think it's over 80% of S&P 500 companies are beating earnings expectations. That's pretty typical. So we've been watching how they're moving more.
That number always sounds impressive, but indeed, that's usually around what the number is. Ali, you've been looking sectorially where we are seeing some of the best performance, not necessarily in the stock, but in the actual numbers.
Yeah, so if you take a look under the hood, there's no surprise here that tech is once again outperforming. And this is also data from Julie and Emmanuel over at Evercore ISI. We're seeing 13% sales growth of the tech companies that have reported so far, nearly 20% earnings growth. And every single company that's reported has had that be on both the top and bottom line. So a strong signal of momentum. Tech has clearly been carrying this rally. But on the flip side, one of the worst performing sectors has been consumer discretionary. Earnings are almost down 30%. Sales have dipped slightly too, but we still have 91% of names still beating on revenue, 73% beating on earnings. We know entering this earnings season that the bar was low, so they're still managing to clear it, but they're is a tale of two sectors here, where tech is the leader on both growth, execution, and then we have those more struggling sectors like discretionary names holding up just enough thanks to those lower expectations. But even if you look at a year-to-date basis across the variety of sectors, consumer discretionary is among the bottom three, along with energy and healthcare. So discretionary is still trying to find its footing, both on the earnings front, along with those stock price performances as well.
And also, speaking of sectors and speaking of earnings, Ines, finally, let's talk about GE Vernova for a second, which has been such a killer performer and is out with its numbers this morning.
Yeah, that's right. And Wall Street absolutely adores this stock. I mean, you look at it and it is up more than 60% year to date. This is the company that spun off out of GE last year in April of 2024. And it is a hot performer. It is a top third performer of the S&P 500. And by the way, XLU, the utility sector, is the second best performer of the S&P 500. And what this company does is they have these gas turbines. They have been selling directly to the hyperscalers, also accelerating their selling to the hyperscalers. And about 1/3 of their gas turbine orders are now tied directly or indirectly to data centers, hyperscalers. So look, this is all about the need for energy and the massive hyperscaler data center build out that's happening now in the US. And this company is definitely riding that wave. Also want to mention, they just recently announced that they will be acquiring a French AI company these are AI tools that utility companies will be able to use for their grids. So again, data centers, AI, and this dovetails very well with what this company is doing as far as their energy is concerned.
Yes, and as you say, all of these stocks have been, many of them at least, have been doing very well. Ali, Josh, Ines, thank you so much. Appreciate it. Well, Tesla is set to release its second quarter earnings report after the bell today. Here with three things investors will be closely watching for in the results. Senior Audit reporter Prasad Ramanian. So what are those three things?
Yeah, so I think we all kind of have an idea what these three things kind of generally are. But number one, obviously, the core auto business, still the moneymaker for this company. But we're going to see a 9% potential 9% drop in revenue there. We saw deliveries were a little bit weak in Q2. How much of that was because of the Model Y changeover? Going to want to hear more about that issue in terms of what is the availability of that vehicle. The robo-taxi rollout, right? So, it went off on time, according to what Musk wanted in June. It's been going on. It's been expanded. Now, there were some issues with local traffic laws and things like that being violated. The question is, are we going to see that expansion continue? Are we going to see the safety driver actually removed from the vehicle so they can come? I mean, look, Waymo is still number one in space by far and away. How close are they getting is the question I think they'll have to answer. And finally, where's that cheaper EV, right? But that cheaper EV was talked about a year ago. We haven't seen it yet. No drawings yet. Nothing. Is it going to be a decontented Model Y or Model 3, or is it a whole new vehicle? I think that's going to be a big part of the case for Tesla's core business. Can they expand that, the sales? They're going to need a cheap vehicle to do that. So we'll see about that. But Dan Levy pointed out that we might not see it until that EV tax credit expires, right? So that might make a reason for them to release that vehicle when they can't get that discount.
Yeah, that makes sense. don't know if we're ever going to get that done. We'll see. Let's talk about Japanese automakers for a second, because I know you have been so focused on the tariff effect on the different global automakers. We're seeing many of these stocks fly this morning on this new trade agreement. I mean, they're still going to be tariffed at 15%, but I guess it's not 25%. So
I mean, Julie, you've been covering this market for a long time. Have you ever seen Japanese auto stocks jump this much in one day? I mean,
it's rare. It is certainly rare.
I've never seen that, and it's extreme optimism about this 15% tariff deal with the U.S. now that Trump announced. It was 25, 27, I think, something like that potentially before that. So a big deal for them. This is a huge kind of optimism boost for them. But it's funny because the U.S. automakers, the big three, are upset about this. They call this a bad deal because they're saying, hey, we make a lot of vehicles in North America, i.e. Mexico and Canada, that have high U.S. content, right? And these Japanese cars have no U.S. content, and they're getting a better deal than the cars coming from Mexico and Canada. Not to mention the fact that the Japanese automakers, some of them do make cars in Canada and Mexico. So it's still a lot going on there from like different parts of the world making cars and exporting them, importing them. But yes, this is very bullish for them. And even the German automakers, as Inez mentioned, rallying on this as optimism for a deal with the EU too.
I just quickly looked it up because I didn't know off the top of my head. Tariffs on foreign cars coming into the U.S. pre-Trump, 2.5%.
Yeah.
A little different.
Yeah.
All right. Thanks, Bros. Yeah. Appreciate it. Coming up, we're going to count you down to the opening bell on Wall Street. Don't go anywhere. You're watching Morning Brief on Yahoo Finance. Let's get to some of today's trending tickers. We are watching Texas Instruments, AT&T, and Fiserv. First up, Texas Instruments' third quarter forecast fell short of analyst estimates despite beating expectations in the second quarter. At the midpoint of its forecast, sales will grow 11% this quarter. That's a deceleration from the prior period. The company's declines extended in after-hours trading during the earnings call when analysts pressed executives to explain a shift toward more negative demand perception. TI is a key supplier of semiconductors for car makers and factories and had so far this year benefited from a broader swell in semiconductor stocks. Next, AT&T's profit outlook fell short of analyst estimates. The company, which is the smallest among the big three U.S. carriers, reiterated an existing full-year forecast that was below what the street was looking for. Earlier this week, rival Verizon boosted its full-year guidance metrics thanks to benefits from President Trump's tax bill. On a positive note, AT&T did report a larger-than-expected surge in mobile customers, in contrast with Verizon's subscriber loss during the same period. Rival T-Mobile will report results Wednesday after the close. And finally, shares of Fiserv falling after the fintech company narrowed its growth forecast to the lower end of its range. During the second quarter, organic growth in its merchant solutions division also fell short of expectations. Mizuho's Dan Dolev, who has an outperform on the stock, said the new guidance calls into question the ramp of strategic initiatives in the second half of the year. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, the S&P 500 closing out another record high in Tuesday's trading session, marking the 11th time this year the benchmark index has clinched a record close. But can this bull market continue to climb that growing wall of worry, as some folks in the industry like to call it? I want to bring in Liz Ann Saunders, Charles Schwab Chief Investment Strategist. Liz Ann, it's been a minute. It is great to see you.
You too.
And I noticed you used that phrase, wall of worry, in your recent report. You know, we all use that phrase, but I wanted to sort of like break it down, deconstruct it a little bit, explain to folks when we say that, what exactly we mean and what the implications are for a rally to keep going, you know, to keep climbing that wall of worry. So what do we mean when we say that the market's climbing a wall of worry? Let's start there.
Yeah, I mean, it's one way to describe how sentiment can drive markets. It's somewhat in keeping with other age-old adages, including from the likes of Sir John Templeton, who said bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. So it's as you start to see increasing concerns, that tends to keep sentiment somewhat restrained, all else equal to the benefit of the equity market. Now, I would argue that's what the market's been doing, but I do think that there is some complacency that has kicked in, especially given what we're now starting to see the retail traders' interest in really far down the quality spectrum. So I think complacency is a bit of a risk, but it's a sentiment-based descriptor of how markets work.
And what tends to happen then, you know, if we're climbing the wall of worry at the same time that we're seeing some of those signs of complacency creeping in?
Well, what's interesting right now is you've got I think, a mixed sentiment picture. Certainly from a behavioral standpoint, you've had the retail traders really dominating this move off the early April lows. And in part, given that heavily shorted stocks have done quite well, that's suggestive of forced positioning changes on the part of many of the future speculators and institutions. So the retail trader sort of came right out of the blocks at the intraday low on April 9th. They still very much have that buy the dip mentality, and it forced a lot of repositioning on the part of institutions. However, although you could argue retail traders might have their sentiment defined as in frothy territory, many institutions really have not moved to risk on mode. They've maybe lessened their risk off positioning, but I would argue are somewhere in that sort of neutral territory, which is also why another phrase may be applicable here, which is the pain trade is probably still higher.
Something else that I know some of your peers on the street over at JP Morgan were looking at was the divergence between the S&P 500 and the S&P equal weight. I know that's a relationship you watch closely also. Yep. And we've been seeing the S&P now start to pull ahead once again. So while all of this other stuff is going on, broadening had been happening a little bit. Are we re-narrowing again? And what does that tell us?
Julie, I think it's going to be in fits and starts. A day like yesterday, which was sort of middling at the cap-weighted index level for the S&P, the equal weight was up, I think, about 1%. You've also got another way to look at a broadening out on a month-to-date basis, and admittedly we're only 3 weeks in here, which is the same thing as quarter-to-date. Russell 2000 is actually the best performer of the major indexes, but that doesn't mean you turn on a dime and you see equal weight or small caps rip higher. But I think we're going to have fits and starts where you do see some broadening out, and more investors are looking for opportunities outside those mega cap names that dominate from a contribution perspective indexes like the S&P.
And another chart you included in a recent note that I thought was sort of illustrative of this, you looked at the percentage of S&P 500 stocks in a bear market, and that has seen a real decline, right? That we're not seeing as many of those stocks. It looks like it's just above 20% right now. So that implies that there is potentially more choice for investors. I know you're a big criteria factors investor. What do you think are the most critical factors that investors should be applying then if they're trying to figure out within the S&P where they should be looking?
Yeah, so given that the rally has had this low quality bias to it, especially more recently with areas like not just the meme stocks, but non-profitable tech, that kind of basket has done incredibly well. We already mentioned heavily shorted stocks. Now you've got the meme stocks moving up the ranking. I think the way to position, given that from a big picture perspective, it's hard to gauge in advance what trade-related announcements are going to be and the impact that might have in the short term on the market. But we can both try to gauge the setup. What's the sentiment backdrop? What's the technical backdrop? What's the breadth backdrop? And then from a factor perspective, I would say, to use trader lingo again, fade the low quality, but lean into higher quality. And the kinds of factors that we think generally fit under that high quality umbrella, but are really essential in this backdrop is strength of balance sheet, strong free cash flow, resilient profit margins, visibility in terms of forward earnings without paying exorbitant valuation. So it's almost what we used to call GARP. In the olden days, growth at a reasonable price. And that's sort of a ballast to the extent you get another pullback phase. That's where you tend to see outperformance. You're not going to win relative to the meme stocks or non-profitable tech, but you're not going to lose much in an absolute sense. Those stocks have continued to do well, but they do represent ballast to the extent you get a bit of a pullback.
Yeah, maybe you sleep better at night. Lizanne, you're going to stick around and join my colleague Brian Sozzi in just a moment. Thank you very much.
My pleasure.
That does it for Morning Brief. Stay tuned for Opening Bid with Brian Sozzi.